Good morning, children. Today we are going to see the partnership accounting of plus 2 course, in which chapter 6 deals with retirement or death of partners. How do you prepare accounts under when a partner retires from the firm? When a partner leaves the firm, partnership firm, it is known as retirement. Retirement, namakku, we know, due to old age, are unable to perform the duties of partner, or a partner may find a better opportunity, he may retire from the partnership business due to personal reasons. So, anything which makes a person to go away from a partnership firm is told to be retirement. And reasons may be due to illness. There may be an accident occurred, or he may be a patient, he may become a patient of any disease, irrecoverable disease, such things, old age, better opportunity elsewhere. He must have got a good opportunity or more returns in some other place or some other business, or disagreement with other partners. Over a period of time, a partner, after learning the basics of a business, his thinking will be different from others. So, his opinions must have not been valued correct. So, there may be a disagreement among the partners by which he wanted to exit the business. Such things are termed as retirement. The firm is reconstituted. Let us say there are 5 partners in a business firm. One want to go off. Other 4 partners may like to continue the firm. So, the person who is going out is called as retiring partner. Other partners, they may continue the business. This is called a dissolution of partnership. The partnership goes into dissolution. A new partnership comes into existence, and the firm continues to function under new agreement. A partner who retires from the firm is called as retiring partner, or you can say outgoing partner. So, for what are the reasons he may go out, that is normally understood. Then what are the problem comes? What are the adjustments needed? When a partner goes out, he invested capital in the business at the time of entering into partnership. Now, his account has to be settled after making various adjustments. Let us say, what are the adjustments to be done? We learned in the previous lesson, when a new partner is admitted into the partnership firm, it is also called as dissolution of partnership. A new partner is admitted after making some adjustments that we are seeing in chapter 5. Now, when a partner goes out of the firm, you have to do the more or less the same adjustments, and then there at the time of admission, when a partner comes inside, he brings in capital, but now when a partner goes out, the firm's fund will be given to him, whatever contribution he made and whatever the dues that are to be calculated, and he has to be paid. Let us see what are the adjustments to be done. Distribution of accumulated profits and reserves and losses. So, before a person goes out, he will try to take away his capital, and whatever the profit, accumulated profits, any reserves created out of profits, and other things are to be, his share is to be paid to him. Revaluation of assets and liabilities, as you seen in the previous chapter. Assets and liabilities are to be revalued to the present value, and if there is any profit or loss arising, has to be given to the retiring partner. Determination of new profit sharing ratio. This is among the continuing partners, those who are going to carry on the business. They have to work out their new ratio and it will be reflected in the new agreement. New ratio has to be found out and the continuing partners stand to gain. You must understand, when a partner is admitted, the existing partners or the old partners stand to lose something in favor of new partner in the case of admission. In the case of retirement, by the exit of one partner, the other partners going to gain something. You have to find out who gains more, who gains less. That ratio is called gaining ratio. This we are going to deal separately. Adjustment of goodwill. Same like in the previous chapter, we have to make a adjustments towards goodwill. Goodwill has to be calculated and outgoing partner's share of goodwill has to be paid to him in cash or into the adjustments into the account. Adjustment for current year's profit or loss up to the date of retirement. We have to work out, because it is not that a partner will go out at the end of the accounting period after calculating profit and loss. Anything can happen, an accident can happen anytime. So, a partner who retires from the firm till the date, on the date, or you can say till the date, we have to find out profit based on previous year's profits. Previous year's profit, based on it, we will calculate the current year profit and a share of his, the retiring partner's share will be added to his capital account. For that, we have to find out on the basis of previous year's profit and that has to be adjusted. And then finally, it is understood, a outgoing partner will not go empty handed. He has contributed capital, he has contributed his labor to the business. So, when he goes out, he has to be paid, his account has to be calculated and of which some amount has to be paid to him. How we are going to pay? How the continuing partners or the business is going to pay to the retiring partner. These are all the adjustments to be done. You know that how the distribution of accumulated profits and losses are done in the previous chapter. How the profits and losses are calculated. Now, in the previous case, this is in the chapter 5, at the time of admission, profit and loss appropriation account, general reserve account, reserve fund account, workman compensation, investment fluctuation, all are given to old partners. Here, now, here we have to give to all partners. We have to give it to all the partners. That is, old partners means here including the retiring partner. So, whatever available amount has to be given to old partners. Old partners means continuing partners and the retiring partner. Now, revaluation of assets and liabilities. How the assets and liabilities are revalued? That is also in the same manner. What is revaluation account? It is an account opened to record increase or decrease in the value of assets and liabilities. It is also called as profit and loss adjustment account and it is a nominal account. That means it has to be closed by transferring the balance to partner's capital account. It is prepared just like a profit and loss account. Profit items on the right side, loss items on the left hand side, balance it, find out the balancing figure. If the profit side sums are more, balancing figure will appear here, that is termed as revaluation profit, which is to be transferred to all the partners. If it is debit side is more, loss will appear on this credit side, that will be transferred to partner's capital. Either way, you have to make a journal entry. Now, coming back to chapter 6, the things what you do for the first 2 points is same as that of previous chapter. So, I am not going in detail about it. So, once you learn in chapter 5, the steps are same, only thing we have to give it to all the partners, including the retiring partner. Now, Next is determining the new profit sharing ratio. We know of the partnership, if one goes out, others may continue. The ratio in which the continuing partners going to share the future profits is termed as new ratio, new profit sharing ratio. It will be more than the previous ratio because one man is going out, his share is taken by the continuing partners. So, they stand gain. So, that ratio is called a gaining ratio. New sharing ratio for the continuing partners. Gaining ratio is calculated. What is gaining ratio? The ratio in which the continuing partners share the profit of the outgoing partner is termed as gaining ratio. Why it is calculated? It is calculated to adjust the goodwill share to be given to the outgoing partner, or you can say the outgoing partner is compensated in the gaining ratio by the continuing partners. So, that is why we calculate gaining ratio. Now, we must see the meaning and purpose of calculation, then how it is calculated. The continuing partners may gain a portion of the share of profit of the retiring partner. It is the proportion of profit which is gained by the continuing partners. The purpose is to bear the goodwill to be paid to the retiring partner. So, retiring partner has to be compensated. Gaining ratio is new share minus old share. So, do you understand the meaning of it? There are various illustrations given in the book how the gaining ratio is calculated. How the new ratio, given with new ratio or given without new ratio, we can calculate gaining ratio. There are around 5 illustrations on that how to calculate new ratio and gaining ratio. It is a 2-mark question, important 2-mark question. You need to understand each one and find out the gaining ratio. What are the difference between gaining ratio and sacrificing ratio? Sacrificing ratio is from the chapter 5 and gaining ratio from this current chapter. This is calculated at the time of admission, this is calculated at the time of retirement. That you must keep it in mind. Meaning, sacrificing ratio, it is the proportion of profit which is sacrificed by the old partners in favor of the new partner. When a partner comes in, old partners give their share in favor of new partner. Here, the outgoing partner's share is taken by the continuing partners. The man who is going out, his share is taken by the continuing partners. That ratio is called a gaining ratio. Purpose, why it is calculated? The new partner has to compensate the old partner's sacrifice. So, he compensates. The ratio in which the old partners give, same way he contributes to their loss. Same way here, the outgoing partner's share is taken by the continuing partners. Same way they have to compensate the outgoing partner. For that we calculate gaining ratio. When it is calculated, it is at the time of admission. Gaining ratio at the time of retirement. How it is calculated? Old share minus new share. There it is new share minus old share. Do you understand? The 4 points, when you are asked to give the differences under 2-mark question, write any 2. This last 2 will be easier. When you are told to write the difference between sacrificing ratio and gaining ratio, in 2-mark question, write these 2 points. When it is asked in 3-mark question, write any 3 points. When it is asked in 5-mark question, write all the 4 points. Understood? Now, next, how the goodwill is adjusted. Adjustment of goodwill. So, goodwill valuation we are seen in chapter 4. Chapter 4 we separately dealt about the goodwill, how to calculate the goodwill and all we saw it there. Now, what adjustments we are going to make, let us see. The outgoing partner's share is given by the continuing partners. let us say if he is given in cash, how they are calculated? From their capital. Continuing partners capital account or current account debit to retiring partners capital account. So, goodwill share of the retiring partner will be deducted from the continuing partners according to their gain. How much they gain? According to the gaining ratio, they will compensate the retiring partner. Let us say for example, if the outgoing partner's share of goodwill is 10,000 and there are 3 partners, gaining ratio is in the terms of 2:1:1. Let us say example. Partner A will give 2 parts, partner B will give 1 part, partner C will give 1 part. So, total 4 parts. So, 10,000 is divided into 4, 5,000, 2,500, 2,500 will be debited from ABC and it will be given to the partner who is going out, Mr. D. So, such way it is done. If there is an existing goodwill, already if it is there in the old company, that is old firm, if there is a goodwill account in the balance sheet of the old firm, then how it is adjusted? It is to be written off or it is to be made 0. For that, all the partners capital account debit, that is in old ratio, to goodwill account. So, goodwill will be written off. It has to be written off. It is a fictitious asset. So, it is to be written off. Intangible but not fictitious. So, it is to be written off. To write off the goodwill, the journal entry is all the partners capital account to goodwill account. It will be written off. Now, adjustment for current year's profit. Current year means the year in which the partner goes out is called a current year. How it is calculated? Because we are not close to the books of accounts. The business is running. So, the accounts will be prepared on at the end of accounting period. If he retires before, till the date of retirement, profit will be calculated from the starting year, the business year. Let us say April 1 to, let us say he retires on October 15. So, from April 1 to October 15, how many months? It is around 6.5 months. So, we have to calculate profit for 6.5 months based on previous year's profit, average profit of previous 3 years. So, we have to take an average, that will be average profit into 6.5 by 12. Like that we calculate the profit for till the date of retirement, and then we make a adjustment entry, profit and loss suspense account, because this profit will be adjusted at the end of the accounting period. So, we have to prepare an adjustment entry, profit and loss suspense account to retiring partners capital account or current account. So, we have to find out how much profit, then we have to credit to the retiring partner, but it is not to other partners, but only to the retiring partner's share, his share of profit. Whatever profit comes after his retirement, it will be shared by the continuing partners alone. So, that is why we calculate profit and loss. We debited a separate account, adjustment account, for making adjustment towards current year's profit. Now, we calculated what are things we are given him. Retaining partners got accumulated profits and losses and reserves share. Then revalued assets and liabilities, then he got revaluation profit or loss. Goodwill share he got, whatever capital, everything, and we arrived at a figure, this much amount has to be paid to the retiring partner. Now he is going out. If the business is having sufficient cash, then we can pay him, okay, settle the account, he can go out once for all, he need not to get back, he need not to come back, paying the entire amount due immediately in cash. So, retiring partner's capital account to cash account or bank account, he is settled once for all. Transfer the entire amount due to the loan account of the partner. So, instead of, if the business is unable to pay him, then entire amount due to him will be transferred to his loan account. Paying a part of amount, you cannot send a retiring partner empty handed. Staying in the business for number of years, he has to be paid something. So we are paying little amount. Let us say he is due for 15 lakhs, we will pay him 5 lakhs and we will tell him this 10 lakh, balance 10 lakh will be paid in the coming years. Such way, partially in cash and rest into his loan account, how the journal entries are made under 3 conditions. When he is paid immediately, retiring partner's capital account, total amount due to him by preparing separate capital account to bank account or cash account, that is if he is paid off immediately. If he is not paid, then transfer to his loan account instead of cash and bank, retiring partner's loan account, and this loan account will appear as a liability in the continuing firm's balance sheet under the head liabilities, this retiring partner's loan account. If he is paid off some amount in cash and balance, then in such case retiring partner's capital account debit to cash account, whatever you pay him amount, whatever you are unable to pay, that will be credited to loan account. This loan account also will appear in balance sheet of the continuing partners. This is how the amount is settled to the retiring partner. Here sometimes this may happen. If a partner is willing to retire or giving a notice for retirement, then he is alive to receive the benefits, or you can say he will get back to the business to receive whatever the amount due from the company. In case of an accident, if he dies, such case how the things will be settled? He will not be there to receive. Now his family will receive the benefits. His family will be given with the benefits. When a partner dies, there is a dissolution or reconstitution of partnership. Like retirement, death is also treated as reconstitution of partnership. The following, what are the adjustments made? Same, like retirement, distribution of profits and reserves and losses, revaluation of assets and liabilities, determination of new profit sharing ratio and gaining ratio, adjustment of goodwill, calculation of current year's profit till the date of death, settlement of accounts of the deceased partner. Deceased partner, he already died. How we are going to settle? Now, the first 5 steps are same as that of retirement, and of which preparation of revaluation account, adjustment of profit and loss reserves, everything is same as in chapter 5. How the things are settled? Instead of loan account of the retiring partner, here died partner's executors account. Executors account. Executors are those persons or legal heirs, legal representatives. They will receive the amount. Let us see the journal entry. To transfer the amount due to the deceased partner to the executors or legal representative of the deceased partner. So, who will receive the amount? Executors or legal representative. Legal representative means legal heirs, his wife or his son, daughter, whosoever may be. Those who are appointed by court. Court will appoint the person to receive the benefits of the deceased partner. So, deceased partner's capital account, the man who has died, his capital account, whatever the total dues, to deceased partner's executor's account. So, from the capital account, it will be transferred to executor's account, deceased partner's executor's account. This is to transfer the amount from the capital account. Now, you will be no more a partner. How the amount is paid? If it is paid in cash, deceased partner's executor's account to bank or cash, if it is paid in cash. If it is not paid, then deceased partner's executor's loan account. Instead of cash and bank, it will be transferred to his loan account, executor's loan account. If it is partially in cash and partially to loan account, then it will be deceased partner's executor's account, and whatever cash you pay, cash or bank, and whatever you are unable to pay, that will be transferred to deceased partner's executor's loan account. Understood? This is more or less same as that case of retirement, hence it is crisply told. Now, let us get back to the beginning. What are the things we learned today? Retirement or death of partners. In case of retirement, what are the adjustments are made and how they are done through journalizing. Let us see. Accumulation of profits and reserves and losses as in admission. Same way we have to transfer to the retiring partners all the partners capital account, that is profit and loss account debit to all the partners capital account. Revaluation of assets and liabilities done to find out revaluation of, that is revaluation profit or loss, and that will be transferred to all the partners. And finding out new ratio and gaining ratio. Adjustment of goodwill. Goodwill is adjusted for the new fresh goodwill or an existing goodwill, if it is there, that will be written off. And calculation of current year's profit, which is new when you compare with chapter 5. So we have to calculate till the date of retirement profit. You have to calculate a notional profit till the date of retirement based on previous year experience and give the outgoing partner's share. Then how the retiring partner is settled, how he is settled, whether he is paid in cash full or nothing is paid, transferring the entire amount to his loan account, or paying him some part in cash, rest in loan account, in his loan account, to be paid in future with interest or without interest, whatever the case may be, for that generation. So these are the various adjustments done. We need to prepare in practical sums, prepare a revaluation account, prepare the capital account, prepare the bank account, then prepare the new balance sheet of the continuing partners. That will be the end of the comprehensive sum under retirement. Thank you children. Have a nice day. Thank you very much.